Good day, everyone. Let's get started. So welcome to our inaugural report and webinar regarding SaaS valuations. My name is Emmett Kilduff. I'm one of the co-founders and CEO here at the Fortia Group. So welcome. We look forward to doing an intense deep dive into lots of data points, trends, themes regarding SaaS valuations over the next hour. So let's jump in. In terms of the agenda, I'll briefly just bring you through an update by the Fortia Group, our M&A advisory firm. We'll then walk through the report. We have nearly 50 slides to walk through at a good pace, and then we'll have questions that you can ask as we go through or at the end. For questions, please submit them via the Q&A tab on Zoom, and we'll answer them as we go. Our panelists can start typing answers as you post them throughout the webinar. Please do not put them on the chat. It's very difficult to field the questions in that method. Like all the webinars that the Fortia Group does, they're all recorded and available on our YouTube channel in the coming days. So let's jump in. So just from a Fortia Group perspective, the SaaS sector is relatively new for us. We started as a business 4 years ago, initially focusing on e-commerce. So a lot of you are new to the Fortia Group, so I wanted to take a step back and explain who and what we are. We are a dedicated M&A advisory firm focused on the lower middle market. So I worked at Morgan Stanley, and before that, Credit Suisse. Since the year 2000, worked on $20 billion plus worth of deal flow over that 25-year period. And what we're looking to do is bring a Wall Street level of service to the lower middle market. The lower middle market, based on our definition of deal sizes ranging from $10 million US dollars to $200 million. And we focus on three sectors. E-commerce is where we started. SaaS is a big focus of ours now, and AI and data. And there's a strong reason why we chose those three sectors, which I'll explain now in a moment. So the three co-founders, who are we and why those sectors? So myself, I've been an investment banker for a long time, but I've also started businesses. I'm an entrepreneur. I started a data SaaS business called Eagle Alpha when I left Morgan Stanley 12 years ago. So that's involved in AI and data, and that's one of the sectors that the Fortia Group focuses. So we have operational experience in that sector as opposed to just corporate finance. My co-founder, David Hyland, he was a CFO of a SaaS business that did M&A in his time there. So he also gets the SaaS sector. And our final co-founder, Paul, he was involved in e-commerce and CPG, which is the sector where we started. So we have genuine operational experience in the three core sectors that we focus in on. One thing that's very different to a lot of other corporate finance firms that we do is every January in New York, we host an annual conference called the Acquirer Summit. It's a conference dedicated to acquirers. We help acquirers think about the latest trends regarding sourcing deals, operational best practice value creation, and ultimately successful exits, valuations, etc. But one of the things we do is invite a select number of companies to pitch their exit to that audience, or indeed just solicit early feedback. So even if you want to sell in 2026, we would strongly encourage you to get a feedback from acquirers to make your business more sellable. So for any of the corporates on the call, the SaaS businesses on the call today, if you're interested in pitching to 100 plus acquirers in January in New York, please reach out to the Fortia Group. So let's walk through the report. First of all, I want to just introduce you at a high level to the speakers. Each of the speakers will come on camera as we go through their sections, and at the end during the panel, we've gathered a super diverse group of speakers here to really have a rounded approach to getting to where the valuations are today. So Ryan Allis is joining, the founder and CEO of SaaS Rise, a leading community for SaaS businesses. Rob Belcher, in our view, as the leading sort of tracker of listed SaaS businesses. Lauren Kelley is the CEO of OPEXEngine, which is part of the consultancy firm Bain & Co. and Mike Dash is the CEO of Threecolts. So it's nice to have someone from the actual acquisition side here with us today. Okay, so how do we go about our report structures? So we've done this for the last few years for e-commerce, and we follow a similar structure, obviously with different data points. So we think there's 4 factors that are outside of firm's control that affect valuation, and 2 that are relatively under a firm's control. The 4 outside of firm's control is 1, just global M&A activity. It's obviously been down in the last while. That affects all M&A activity. There's no way of getting away from that. SaaS trends, what are obvious macro category SaaS trends, and Lauren will talk to that. Public market comps, always need to be taken into account when looking at private market comparables, and Rob will look at data points there. SaaS M&A activity, Threecolts we'll discuss the sort of the M&A activity that they are doing over the last few years and what they're seeing ahead of 2025. Firm metrics. So how is your firm doing, or how are firms doing in general, in terms of the rule of 40, etc., and how does that affect valuation? And ultimately, deal dynamics. A lot of entrepreneurs forget about this, but there's a lot of factors that affect valuation in terms of the buyer situation, seller situation, and I'll go through some of those with you all. Ultimately, we'll finish by giving the Fortia Group's house view on where valuations are today, and then we'll answer your Q&A. Okay, so I'm going to start with global M&A activity. Let's take a look back first and think about precedents. So September finally was the month when we saw the Fed cut rates, which is great, and there's obviously a strong link between interest rates and M&A deal flow. So if we look back at the prior cuts back in Q3 2009 and Q3 2020. In the year following those cuts, there was a substantial increase in M&A deal volume. In 2009, the credit crunch, it went up 26%. In 2020, went 23%. So precedent looks good. Actually, given where we are, the precedent should be better, because unlike the global credit crunch and the COVID situation, we're in a better place. We have the result of the US election. We have reducing interest rates, and hopefully inflation is in check. So where does that leave us as we look ahead to deal volumes for 2025? I have a lot of respect for the Parthenon team at EY in terms of M&A and deal analysis, and they've come up with a chart for US private equity, and in a moment US corporate stroke strategic. So you'll see from a PE perspective, 2021 was a bumper year, just like it was for corporates. No getting away from the last few years being tough. 2022, 2023 decline, slight increase 2024. No doubt for certain sectors. There's still been a decline. We know from our own perspective, e-commerce is declined for 3 years in a row. Overall, though, there has been an increase, which is great, and the baseline forecast for next year from EY is 16%. So that's a positive, and there's similar cycles. I've seen this since the year 2000. Actually never in the reported M&A cycles has M&A overall gone down for 3 years in a row. So with interest rates reducing, we're on an upward trend. If you look at corporates and strategics, again, 2021 was a huge year, 2 years of decline, a bounce in 2024, and a baseline increase of 8% in 2025. So for entrepreneurs thinking about a deal in 2025, the environment gets better, which means there's probably hopefully more competitiveness in the auction, more chances of frankly just getting a deal done, and ultimately then more chances of a higher valuation. Okay, we'll go to SaaS trends now, and I'll invite Lauren to take the floor. Lauren, are you there, please?
Hi, nice to be here. Thanks, Emmett. I'm Lauren Kelley, CEO and founder of OPEXEngine by Bain Company. OPEXEngine has been benchmarking B2B software and SaaS companies for almost 2 decades now, working with leading public SaaS companies as well as hundreds of private SaaS and now currently with PE firms investing in SaaS. We map companies' operating metrics against our benchmarking framework to deliver apples to apples benchmarking analysis against peer companies and peer cohorts. Companies use our benchmarking to identify what good looks like across operating areas to compare productivity, expenses, headcounts at a fairly granular level. We were acquired by Bain Company in 2021, and we've been incorporating Bain's value creation and expertise in working with private equity to help SaaS companies improve operating efficiencies and achieve higher valuations through benchmarking. So I'm going to talk a little bit about what the current trends in valuations for private companies are. If you could advance the slides. So in this slide, we're looking at both EBITDA and revenue multiples at current exit for the years 2014 through 2023. We're looking at fully realized exit multiples for the top quartile, median, and bottom quartiles of valuations for private SaaS companies, software and SaaS companies. All the data here comes from PE firms through our sister company, DealEdge. They collect something like 40,000 PE transactions a year, and 40,000 is not all software, but this is narrowed down just to software and SaaS. What's super interesting that we started to see in 2023 is that the delta between median and top quartiles is greater than it's ever been before in terms of both revenue and EBITDA multiples, if you look at it either way. And as we'll see in the next slides, top quartile valuations are highly associated with strong operating KPIs and Rule of 40. In general, SaaS companies are achieving higher growth rate. SaaS companies that are achieving higher growth rates are valued on revenue multiples, while companies with average or low growth, currently we're seeing more being valued on EBITDA multiples. And we're seeing this trend continue in 2024. So here is an average return in terms of separating out lower 50% of deals by IRR versus upper 50% of deals by IRR. The top tier SaaS returns are distinguished by a combination of growth and operational excellence. So if you go to the next slide, this is also reflected to some extent in public SaaS multiples, although we see it more strongly in private valuations. Definitely revenue multiples in the public markets, despite the high levels of the stock market recently in the past year. In general, revenue multiples have decreased since 2021. And that what we're also seeing is that valuations going into 23 and continuing now in 24 are more highly correlated to a strong Rule of 40. If we go to the next slide, I think it's important to remember and just think about the scope of the data when we're talking about SaaS. The scope of the sector for SaaS itself is broken up into so many different sectors. And there are some SaaS segments that are reaching maturity. And then there are other sectors where these sectors are newer and growth is accelerating. And on top of that, there was such a flood of investment into SaaS and technology in 2021, where so many companies were funded that growth in some of these sectors has currently really been more limited to one or two market leaders and larger companies, which is kind of an interesting dynamic because usually in the past we've seen in economic slowdowns that customers oftentimes buy best of breed. Whereas recently, in the past year to 2 years, we're seeing large enterprise customers focus more on larger, credible vendors as compared to buying from small. So we're seeing growth slowing for smaller companies. But this spread in sector maturity is another reason, I think, why we're seeing such a delta in valuations when you look at, software and SaaS overall. And so you have to really separate out the fast growth companies from the slow growth companies. If we go to the next slide, it's well known, I think, across the board that SaaS value creation has moved from growth at all costs to profitable growth since 2021. And what we do is look at operations and how operational efficiency ladders up to value creation and is driven by the KPI's underlying efficient growth. And what do we mean by efficient growth? It means that the investment in go-to-market, sales, marketing, customer success are, as well as product investment, are producing comparable growth in underlying efficiency metrics to peers. So performance metrics like magic number, R&D ROI, which is a KPI to measure previous investments in R&D by dollar and what dollars of new growth are coming from that, as well as sales efficiency, which is a variation on the magic number, are critical to assess and then dig into the operations affecting them, which brings me to the next slide, where underneath each level of sort of composite performance metrics, there are other underlying operating activities and expenses that drive productivity. And it's important to understand how you compare against other firms, particularly in the current market. We're seeing these numbers improve. CLV to CAC previously used to be something that 3 or 4 was a good CLV to CAC, whereas now we're seeing more standardly in 2024, 8 or 9x for CLV to CAC. We're seeing stronger customer retention and gross dollar retention than we were seeing before, even as net dollar retention in general has come down. If we go to the next slide, I know we only have a short time here, so I want to take a few minutes and just summarize some of the ways that you can see how these numbers are improving. For companies with higher levels of EBITDA, we're seeing higher rules of 40, where even rule of 50 is what good looks like. As I said, CLV to CAC, we're seeing more like 8, 9, and sometimes even much higher numbers. Magic number, our estimates of magic number, because of the way we calculate it, are conservative, but anything above 0.5 to 1 on magic number is generally considered good. And then R&D ROI, what this is saying is that companies with higher EBITDA tend to be getting $1 at least of new growth from their previous R&D investments. And if you calculate that for a lot of companies, it's much lower than that. And then, of course, revenue per employee is going up. So with that, that's my quick overview of SaaS operating trends right now. I'm happy to take any other questions and continue the discussion in more detail.
Thank you, Lauren, for getting us off to a super start. If anyone has questions for Lauren, please put them through the Q&A button and we'll address them later on or at the end. There is one question there, Lauren. If you get a chance, please do take a look. Excellent. Okay, we will now double down on public market comparables, and it's over to Rob, please.
Yeah, thanks, Emmett. Thanks, Lauren. Good to chat with everybody. I'm Rob. I run SaaS Capital. Our day job is to lend money to SaaS companies. We're in the venture debt space. We don't track the VCs per se. We lend to bootstrap companies all the time too, but that's our day job. And as part of that, these companies obviously are borrowing money to grow and raise an equity round or to sell or whatever. So we, as our second day job, track a lot of the market, both private and public. We have an index we've developed of about 90 public SaaS companies. that look and feel like the types of companies we would lend to, but only they were smaller and earlier stage and more growth stage and not public. So they're designed. These are B2B only. They're designed to look and feel a lot like our portfolio companies, except just public comparables. So it's a curated list, and there's some odd 90 of them or so. Fascinating thing is there's only been 2 IPOs this year. There was 1 last year. It's been very, very quiet compared to times in the past. And so my section here will corroborate and a little bit support some things Emmett shared and what Lauren shared. So this is our index over time, starting all the way back in 2008. I think there were just 12 companies in the index at that point. And you can see, obviously, the big boom in SaaS valuations during the pandemic. And the current trend has been around 6 times. And this is all current run rate ARR. Some folks do forward looking, some do all kinds of different things. This is current run rate ARR valuation multiple. And we saw a pretty big post-election tick up here in the end of November. So we're up to 7.3 times ARR. That's the current state of things. This is my section is going to be a little bit of sort of the macro and things to think about and like where we are in the valuation land temporally. So on the next slide, you can see, I think a lot of folks, as Emmett said, the M&A world and the VC and the PE deals are down, and that's because valuations are down, right? And valuations are depressed. Well, that is true compared to the pandemic, but actually, so there's these 3 sections of time. We've got the blue dots are all the sort of big growth period of SaaS between 2010 and 2020. The orange is during the pandemic, the elevated valuations, and the yellow is since then, so 2022 and 23. And along the x-axis here, you have growth rate. So how is the market rewarding growth on a valuation basis? And you can see that our current environment is very similar to before the pandemic and before the big boom. In fact, it's actually even 2 turns of ARR higher than that period. But generally speaking, the market is rewarding growth the same as it did before, kind of back to status quo is how I describe it, maybe even a little higher. And obviously, the market was bananas during the pandemic and sort of 2021 and 22, and valuation multiples were very high. And notice that the growth rate was negatively correlated with valuation. So the market was just crazy, and that's the crazy time, and now is actually normal. But it feels depressed because obviously valuations are down 10 years worth of revenue compared to where they were a few years ago. So that's kind of what's happening, and that's what we're seeing in the market today. Interesting thing on the macro front. So we're gonna talk. Lauren talked a little bit about profitability and growth, and so that's been the big key. Those are the big keywords over the last few years. And so on the next slide, you can see profitability versus growth in the public companies that we track over time. Blue is growth rate, red is profitability. They're on separate axes, but we've overlaid them on purpose so you can see how they relate over time. And there's a couple interesting regimes. There's about 4 different regimes through time here that you can see where we've focused more on growth versus profitability and vice versa over time. And we're in this big phase right now of profitability after a period of growth at all costs. And then let's see what else was happening along the same period of time. On the next slide, we can see interest rates. And so now on the very next slide, we'll overlay both of these together. That's the federal funds rate over time. And very interestingly, you can see that in a 0 interest rate environment, money's free, grow at all costs. When money's not free, grow at all costs doesn't make any sense anymore, and we need to be profitable. We need to be making money. So this is something that we've taken a look at recently, and this is Emmett was talking about this, right? If the U.S. Fed is cutting and has indicated will continue to cut gradually, slowly. We think it will be slow. We don't think it'll be a very fast cut. Inflation is kind of sticking around a little bit. It's around 3% right now, still elevated from the target of 2%. So we're thinking that the market will interest rates will gradually come down, and we will gradually, I was thinking back about a year or 2 ago, I was expecting a tsunami of M&A deals. This wall of capital sitting around waiting to do deals and waiting for valuations to return. And I'm reconsidering that approach, and I actually now think it'll be more of a gradual tide rising of M&A as interest rates come down, growth rates accelerate, more deals to be had, et cetera. So that's kind of what I'm thinking is going to happen over the next year or two. I think that's my last slide.
Thank you, Ryan. When do you think the lines will cross again? The orange, blue?
Not for another year, I think. It's going to be gradual. I think it's going to be a while. Again, I thought it was going to be fast a year or so ago, but I think I'm actually kind of curating my sort of 2025 look ahead, and an important bullet is uncertainty with the U.S. new administration and sort of tariffs. Tariffs is sort of a second order effect on, that's been the big word here in the U.S. In terms of economic policy. It's not, it wouldn't have a direct impact on the SaaS market, but it would be second order. There's immigration stuff too. There's a lot of immigrants that are founders and employees of software and technology companies. So there's some like uncertainty there. It could be not a big deal. It could be a medium-sized deal. I don't think it'd be a huge deal for the SaaS industry, but so I think steady as she goes, possible some downside risk, gradual, if anything, no dramatic. I don't think anything will happen quickly.
I mean, it's a great chart, but it also highlights one of the difficulties for entrepreneurs looking to sell their business, because you need to sort of think ahead and skate to where the puck's going to be. So if you want to sell, if you want to sell now, clearly you got to be thinking about profitability. But in 2 years' time, when this chart maybe inverses, it might be back to growth. Who knows? And then you've got to be demonstrating that ideally to get the best exit. It's quite difficult for entrepreneurs.
Yeah, I like your bubble chart to start. The things that are not in your control, right? The macro is key. Like you are where you are in time, and what's going on in the world around you is not in your control.
Yeah,
thanks.
Very good. Thank you, sir. Okay, thank you, Rob. We will go to Mike to talk about SaaS M&A activity. Welcome, Mike.
Hey, everyone. My name is Michael Dash. I've been in the e-commerce space for close to 15 years now. I've been through a number of different exits, two personally, one in e-commerce directly for an online store that was sold to a private equity-backed strategic, and the second to Threecolts, the company I'm at now. Threecolts is a serial acquirer of software companies within the marketplaces space. We've been around for about 3 years. If you can go to the next slide, I can talk a little bit about Threecolts and what we do. So, yeah, as I mentioned, we've been around since 2021. We've acquired over 20 companies since then. I've led the bulk of those. This year alone, I've analyzed over 100 software deals in the space, talking to a variety of different founders, bootstrap founders, VC-backed founders, private equity-backed founders, all the like. And we've seen the trend over the past few years, as others talked about, of decreasing multiples. We see the ranges on these, which I'm sure everybody's curious about, being in the 2 to 10x space. And I think it's also very specific when we talk about the actual space itself. Some garner higher revenue multiples, EBITDA multiples, and it also is really dependent on the type of acquirer who's looking at the business itself. So the different types of acquirers are strategic acquirers. That's probably who's going to pay the most for a specific business. That's somebody who's probably within your space or adjacent in your space, has more use from your business than just the business itself. Maybe it's the team, maybe it's a strategic initiative they're looking at, or what's not. The second would be private equity. Private equity looks at deals a bit differently than a strategic would. They're looking different metrics, different growth metrics. Definitely churn metrics are one of the most important for them. And then the third would be maybe a serial roll-up company like ours, who's acquiring multiple companies, holding them in a portfolio, either integrating them or not, holding them as holding companies, disparate or together. I could talk about us specifically. We're looking at things like growth of the business. It's very difficult these days to buy a business that's declining. Profitability of a business. We've always looked at profitability, but these days, especially, profitability is one of the most important metrics that we're looking at when we're acquiring businesses. The NRR churn of a business, very difficult again to acquire a high churn business. You know, if you're having difficulty yourself as the owners and operators of business for many years, decreasing churn, it's very difficult for the next person to come in and think that they're going to do a better job than you. So having low churn is very, very important. It's kind of like the, oh no, we can't screw this up, and we'll pay more for this business. And then finally, it's the team dynamics and culture fit of what you have going on. So we're always looking at that as we're acquiring. You can imagine if we're acquiring 20 companies, we've got over 500 employees internally now. It's very important, the people and the processes that we're adding on board. We've got a very, very rigid post acquisition process that we're looking at. All these things are very, very important for us when we're acquiring into players in the space or adjacent spaces. So what I talk to founders about constantly for a successful process, and ours is very buttoned up. We usually close within 60 days of talking to founders. Sometimes it's really, really quick. If financials are in order, so you really need a clean P&L and balance sheet, then in your customer data file, usually you can export that from a Stripe or a third-party player in the space. Having very, very clear and honest transparency within your business, what you're doing, how it's running, the intricacies of the business, knowing it top to bottom, and explaining that to acquirers is very, very important. And then clear communication throughout the process itself. So if you're delayed, maybe you're having problems with the team internally, lawyers, whatnot, we've kind of seen it all. Just being open, honest, and communicating with the acquirer themselves. These things are going to make it really, really easy to get yourself acquired. Typically, we're looking and we're reaching out in the space. So it's rare that we'll have an inbound of someone coming in and say, hey, we want to be acquired. So you will usually reach out to a company and say, hey, we're interested in acquiring you. We get that question a lot as well. So yeah, I know my section is a bit brief, but I'm happy to talk about the extensive M&A that we've done in this space, what we've seen. I talked to a lot of other roll-ups and private equity players in the space, strategics who are acquiring. We're one of the most acquisitive, but we've seen a lot out there as well. So kind of wrap with that.
Very good. Thank you, Mike. Again, please submit any questions you have for Mike, and we can get to those after all the sections. So I'm going to just jump out of the master deck, if you don't mind, for a second, and move to some slides that we didn't have enough time to integrate. So Ryan, over to you, please. Welcome, Ryan, from SaaS Rise.
Hello, everyone. Ryan Allis from SaaS Rise. I'm a tech entrepreneur, built a company called iContact, exited that, and now I run a community called SaaS Rise for software as a service CEOs and founders. And these data are from our own internal experiences of what we're seeing in the market. We have 400 members in the SaaS Rise community now. You can go on to the next slide. So the main point here is that, as we've already said on the call, it's a great time to sell. The sort of COVID bubble, if you will, was a once in a lifetime type of experience. We're not going to see those types of multiples, 15x, 20x ever again, most likely, in a zero interest rate policy environment. But now we have to say what has already been made on the call clear, that we are actually in a better time than normal times. And so this myth that valuations are depressed, while maybe acquirers want you to think that, that's not true. We're going into a time right now where we're at relatively low inflation, at least over the last year over year. We're at low unemployment, 4.1%. We're at high GDP, 2.8% year over year in the US. And we have a good administration coming in that's generally more favorable to public tech M&A, with a brand new FTC chair coming in that's going to open up the floodgates with public tech M&A. That is going to then trickle down in the private markets. We have crypto at all-time high. Bitcoin's approaching $95,000, $100,000. And so we are seeing, if you go on to the next slide, that we're expecting an all-time high for the number of deals that will get done in software as a service M&A next year, above the 2022 record. And so when I sold my company iContact in 2012, there was about 300, 400 deals a year. Now there's over 2,400 deals a year. And if we just hit the Q3, which just finished, pace of, we will hit over 2,300 M&A deals next year. So we're excited about that. We're seeing median revenue multiples around 4 to 5x. If you go on to the next slide, and median EBITDA multiples around 20 to 25x. This is just an example here, the median 5.3 last quarter, and the average 5.3, the median 4.1 trailing 12-month revenues. Last slide here, if you go on, we'll just provide some longer term perspective. You can see here that even though the EBITDA multiples are not quite what they were in 21 or 22, still 22 times EBITDA is median for SaaS deals. And if you zoom in at the bottom right there, you can see 31x in the USA, a little bit lower in other places. And so it is a great market. Things have gotten even better since 2023. And I think 2025 is going to set the record for the most deals in a single year. I'll end there. If you have any questions, feel free to put them in the chat window. Happy to chat and excited to be part of this community. We're not hearing anything.
Oh, thank you. So let me touch on deal dynamics, and then we'll move to valuation. A few factors we want to make the entrepreneurs aware of. Some obvious, some less obvious. So from a seller perspective, dynamics such as urgency, preparedness, advisor involvement, shareholder alignment are all important factors when one thinks about valuation. Sellers who are thoughtful with time and preparation ultimately are best positioned to get the best deals. Like S&P 500 companies spend 1 to 2 years planning exits. I would encourage entrepreneurs, earlier stage entrepreneurs of small and medium-sized businesses to do the same. Otherwise, you're at the risk of leaving some money on the table. From a buyer perspective, it's important for sellers to understand the dynamics of the buyers. What are the synergies? If it's strategic, what are the strategic, financial, and operational synergies? Acquisition cycles are important. Industry focus, competitive tension, deal structure, they're all important from a valuation perspective. You know, that's obviously where an advisor like the Fortia group can come in, as we spend lots of time speaking to acquirers, strategics, private equity, family offices, roll-ups all the time. From an advisor perspective, obviously we would encourage entrepreneurs to work with an M&A banker. That's what we do. I've been doing M&A and investment banking since 2000 for nearly 25 years, worked on over $20 billion worth of deals. So that's what I do. I couldn't run you know, lots of different other types of businesses. So you know, we all have our expertise. It's really important to get other smart commercial advisors on the team as well, particularly lawyers. We've seen lots of deals get stalled because lawyers are non-commercial and take ages to do turnaround of materials, etc. Accountants are obviously key. We've touched on that earlier. You know, getting the numbers ready properly is absolutely critical. Tax advisors to make sure you get as most of the money in your pocket as possible, and operational and marketing consultants can help with positioning and in the run up to a deal. Length of process. It's important to think about. I mean, we use this term internally: flirt, date, marry. You know, the best relationships follow that practice. It's very hard to rush. We like to flirt with potential buyers to get on their radar early before we start a formal process. We like the actual process to be efficient from a time perspective, but it's important to flirt and then date, and to really understand who your best partners might be before starting on an efficient, you know, process, which takes you know, can take 4 to 6 or 7 months. Certainty of close is key. Financing is important. You know, some acquirers have money in the bank, some don't. Some are contingent on raising or getting you know, other forms of capital. That's really important to understand. It can delay deals and can have an impact on valuation. So you know, understanding the precedent deals, speaking to founders who've sold to acquirers before to get the real story as to how you know, what their views are of acquirers is important. Okay, so the most important section, as all roads lead to valuation. So 2 slides here that I want to take you through. First of all is Our summary. So at the very start of this webinar, we talked about 6 factors that affect valuation. So I want to take you through our thinking and scoring of each of those factors. And this incorporates the materials from my fellow speakers. So we're scoring global M&A activity today at a 7. Obviously, post the Fed rates reduction, we're going to expect increased M&A, but we're not near the levels of 2021 and 2022. So it's not going to be an 8 or a 9, probably for until the end of next year. But we think it deserves a 7 because we're thankfully now on a good path. From a SaaS trends perspective, if you look at the data that Lauren presented, we think generally SaaS trends are at a 6. There's definitely a move from growth at all costs to profitable growth, and subsegments may be reaching points of maturity. So it's not rosy for every SaaS company, but it's not a bad point either. From a public market comps perspective, we've scored it low. We've scored it at a 5. I've been tracking the SaaS Capital Index for several years now, given I own a SaaS business, Eagle Alpha, and I do remember the lofty days of 2020, 2021 when it was 15, 16x. It's down at 7.3. Thankfully, that's up 2024 year to date. So we scored it at a 5, which I think is fair until it recovers further. SaaS M&A activity. We scored a 7. There are deals getting done. There mightn't be IPOs getting done, but there are M&A deals getting done. The likes of Threecolts are active and continue to be active as we get into next year. From a firm metrics perspective, Ryan gave us some of his thoughts. I think all the speakers have mentioned the rule of 40. There seems to be a trend towards higher profit margins to make up for harder to achieve revenue growth. But generally, we scored firm metrics at a 7. Obviously, then we'll see in a moment the valuation of a specific firm depends on the specifics of the firm's metrics. Finally, from a deal dynamic perspective, we think with reducing interest rates, there'll be cheaper credit, cheaper availability of capital for financing, which ultimately will help acquirers like Threecolts and private equity do more deals. And as one speaker alluded to, there's a huge amount of dry powder sitting on the sidelines that needs to be put to work. So let's see private equity step up next year and do more deals. Okay, so that's our score of all the metrics. We're at a 39 out of 60 overall. So what does that mean for valuations? Well, based on all of that, here's how we see it. We see the majority of growing and profitable SaaS firms trading at between 3 times and 7 times revenue. And I think the median mentioned by a few of our speakers, in around 4, 5, dovetails with that nicely. There are clearly deals getting done below that. We term those distressed, and there are always exceptions, such as diamonds, where it might be, as Lauren was alluding to, could be the rule of 50 or even 60, and those types of firms can command very attractive multiples. So that's what we think is fair today as of December 2024, 3x to 7x. Okay, so now we're going to open up. We've got nearly 15 minutes before we finish, and we're going to I'll invite all the panelists, please, to turn your cameras on, and we will go to questions. There was a question in the chat. It would be great to address the variation in SaaS multiples at different stages. What are the revenue inflection points that unlock higher multiples? So do our speakers think that, if you get to 10 million revenue, 25, 50 million revenue, then you earn the right to get into higher brackets of valuation multiples? Who'd like to comment on that, please?
I can comment on that to start. I've just seen quantitatively in the data that if you can get past the 10 million in ARR range, it certainly helps. What I've seen in the data is there were 118 deals in 2023 that were SaaS M&A deals between 1 million and 10 million ARR. And the median there was 4.2x compared to the overall group of about 355 sample size, where the median was 5.3x. And so there is about a 20% increase in average valuation if you can get above that 10 million ARR range. There's just a bigger discount because you're just not public. The closer you get to being public, all other things equal, or have the opportunity at least to go public at 100 million ARR, the closer you're going to get to those public company medians of 7-8x.
Thank you, Ryan.
And I think just to add to Ryan's point, it's both the possibility of going public, which increases the value opportunity, but it's also public companies or large tech companies being interested in acquiring you. You have to be of a certain size before it's worth it for them, because the cost of acquisition in terms of everything, if they're public, so much disclosure that has, that just is quite costly. So if the revenue level is too low, it's just not worth it. So they're not, unless there's some specific technology or product synergy that they're looking for, in which case it's just like a little tuck in. So definitely
And
revenue
related-
size affects it.
And related to that is not just scale and whether it's worth it, but growth rate too. We've heard that strategics won't, they're very much disincentivized to acquire anybody who's growing slower than they are themselves, right? Adding in somebody who's growing less than they are lowers their growth rate. It makes no sense. So they only want to acquire folks who are growing faster than they are. So it's not just a scale, but a growth rate thing. And I totally agree. Around 10 million, it just opens up the world of possible acquirers or investors. There's just more folks out there. There's more money and so it's more competitive. And so there's more options for you. So that's a good milestone. And a lot of our borrowers are targeting that, or 20 million is sort of the next one.
The other thing I should mention on PE is also that, to your point about there's a lot of dry powder out there. There are a few, or there's a segment of PE firms that are focused on the lower mid-market, as you've defined it, Emmett. But for others, it's just not worth it unless they can deploy a lot of capital. And so they're only interested in doing that if it's a larger company.
Yeah, needs to move the needle.
The other really important point for a PE, which is I hear all the time, is if you are smaller, let's say 5 million, 7 million, even 10, for a PE to be interested, if you have other strategics that you could bring along with you as part of the acquisition. So if you say, hey, I'm interested in getting acquired, I also know 3 to 5 others in the space who could be acquired along with us. You could put those together, and now all of a sudden we're a $40-50 million portfolio. That's when they're really willing to deploy a tremendous amount of capital, and they actually pay a premium for a couple in the bucket. So they'll look at things on an average weighted basis. So one, they'll be willing to pay an exorbitantly higher than normal exit price for, if they can get another for a compressed exit price, so that it weights down the average of whatever it is, 10, 12, 15x. So I've seen that a lot, and I've heard that from a bunch of PE folks in the space.
Yeah, if any entrepreneurs on the call want to talk about a club deal, the Fortia group is very happy to help bring that together and package it for the buy side. Great. There was a question on the back of one of your comments, Lauren. To what do you attribute the significant increase of customer lifetime value to CAC?
Yeah, I mean, I think Ryan alluded to or said in his answer on that, sort of the higher level driver is that the pressure has been on for the past couple of years to software and SaaS companies to reduce expense and be more productive. And if you look at CLV to CAC, we're definitely seeing that when you compare 2021 expenses in go-to-market compared to today, companies are cutting expenses and getting more efficient growth, for every dollar spent in go-to-market, which then improves CLV to CAC. Because what is CLV to CAC made out of? It's just a calculation of your ARR, your gross margin, your retention, and CAC. which is your cost of acquiring a new customer. So a couple things are happening there. In some cases, CLV to CAC is going up because companies are having a hard time acquiring new customers and they're shifting resources just to retention. There's not as much money being thrown sort of randomly at acquiring new customers. And when it is being spent on acquiring new customers, they're getting more efficiency out of that. So that just improves the ratios. But I think there was an incredible focus on one metric in 2021 and 2022 of net dollar retention. You saw lots of writing about that, but that, just like any kind of sales incentives, there can be unintended consequences when you have incredible focus on one metric. That customer retention overall wasn't looked at as closely. And now that's shifted because I think companies realize the interplay between the different retention rates.
Thank you, Lauren. My question for you from Zach. What are you seeing in terms of the multiple arbitrage opportunity for roll-ups?
I mean, it really depends which specific space the roll-up is acquiring in, but typically roll-ups try to pay like most a compressed multiple within a given vertical. So you can get a bunch of deals done between call it 4 and 8 times EBITDA, and you're valued yourself between 10 and 15, you get that multiple arbitrage right away. So dependent on the price of the debt that you're paying, which I would imagine most are paying debt in the roll-up world, you'll get the multiple arbitrage there. And so long as the companies are profitable and you can make payroll and hit your interest payments, you can hit a pretty good multiple arbitrage as a whole. But it's typically what we're seeing across the space.
As a comment there, 4 to 8 times EBITDA for a roll-up is crazy. That's
yeah, it's, again, very industry specific, but it's out there. There's a lot of deals being done in the roll-up space in general, but it's also, it depends on the type of seller of the SaaS. If you want to close really quickly, if you want to be paid cash up front versus earn out, if you want to be able to exit the business and not stay on board. I mean, there's a lot to consider when exiting a business itself. So, a lot of considerations are there for people when they are exiting in every different circumstance.
There was a question about upfront versus deferred. With our e-commerce deal experience, we noticed, 3-4 years ago, people were getting up to 80-90% upfront for e-commerce acquisitions, and that's now sort of between 60 and 80%. Are people seeing similar trend in SaaS deals?
It's definitely heavier upfront than it is earn out usually for a SaaS deal, especially if the growth rate is there, team is good, and whether they want to stay on or not, whether they want to roll equity or not. But the upfront component is generally the largest driver for most people that are exiting their businesses across the board. So.
Absolutely, because I mean, earnouts were invented by buyers many years ago, and half of them go to litigation. I've seen that for far too many years. What would you describe as high churn in SaaS?
I'll take a quick stab at that, but there's a variation between companies selling in the SMB versus companies selling enterprise. And when you talk about churn, it depends on whether you're talking about customer churn, net dollar churn. In the SMB space, it definitely, particularly now, seems to be stronger. We were seeing 60-70% retention rates in SMB up until recently, and then top quartile would be 75 to 85 or 90% in the SMB, and enterprise should be anywhere from ideally 90% retention of customers contract retention, net dollar retention, has been coming down. There's only so much that you can expand depending on your business model with your customers, but I think average rates are around 107% we saw through Q3 of this year for more enterprise type companies. But then, companies with higher average contract values, we still see 110, 112% net dollar retention, or even higher.
Thank you, Lauren. So we have 3 minutes left. I'd like to just ask each of you for your one key takeaway to leave with all the listeners as they think about valuations and deals going into 2025. Who would like to kick off, please?
I'll kick off and just say now is a great time to sell. If you're thinking about selling in the next 24 months, seriously consider beginning a process in the first half of 25. I think it's a great time.
Thank you, Ryan.
I'll jump in. Sorry.
Go, Lauren. Go.
Ed, Lauren. Yep.
I'd say it has never been more important than it is today and going forward to understand all of your operating investments and your return on those investments, and to be data driven and not just understand your own data, but to understand what other companies are doing, because the cost basis for gross margins, the cost basis for go-to-market are changing, and it's going to continue. We expect that in 2025, it's going to continue to change quite a bit. So stay on top of it.
Thank you, Lauren.
My comment is kind of an observation and a comment going forward, is that we had relatively few transactions in our portfolio. We normally see over the last 10 or 15 years, we've had a pretty good velocity of deals happening and VC rounds, and it's been very quiet. But every single one of them over the last 18 months has been a strategic exit. It's been a strategic company buying one of our portfolio companies. And that's basically unheard of for the last 10 years. It's always been PE firms buying companies, not always, but the vast majority has been PE firms or VCs. So the comments we had earlier about hitting a certain revenue level and becoming interesting to strategics, they're out there, they're hungry, they have liquidity. The private equity firms have dry powder, but they maybe are waiting for distributions. They're between funds, like they have their own whole thing going on, but the strategics are sitting on cash and are looking to do deals. And all of those were great outcomes. So something to consider going forward.
Thank you, Rob. Mike, to finish.
Yeah, I agree with everybody's sentiment here. Definitely a great time to sell. The market's starting to pick up a little bit. Velocity's picking up as well. I agree. I think it's great to have a great representation when you are thinking about selling, somebody who's been there, who's done it, and can give you guidance if you've never done it before, to get the maximum potential multiple on your exit. Yeah, best of luck to everybody in the space.
Well, that leads me to thank our speakers. Thank you, Lauren, Ryan, Mike, and Rob. As a reminder to everyone listening, the deck will be circulated tomorrow, and the recording will be available on YouTube in the coming days. And we look to do this probably every 6 months, twice yearly. So thank you all for listening, and wishing you the best for the holidays, and see you in the new year.
Thank you very much. Good discussion.